Thank you for watching this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps financial advisors, money managers, and individual investors understand the trend direction and the current level of risk in the stock market, allowing you to make better asset allocation, investment, and trading decisions, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, August 21st, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. We were up 72 basis points, so 0.72% for the week on the S&P 500. And we made a new all-time closing high both on the week as well as the day, because today, Friday, and we'll talk about this on the next chart as well, but today we closed at 33.9724, so that is also the all-time closing high for the week, but also for the day. So 33.9724, a new one-day and weekly record for the S&P 500. The first chart that we're looking at is a 3-year weekly candlestick chart of the S&P 500, and the blue line is the 40-week moving average. And what I want you to notice here is look at this huge gap where we're trading above this 40-week moving average. And if you go over here to the left, back to 2018, anytime you get this far above the 40-week moving average, you are very vulnerable to a pullback. And as you can see here, we pulled back right to the 40-week moving average. You gapped up, pulled back to the 40, and then eventually went lower in Q4 of 18. We get above this again. You can see that gap there. We pull back to the 40. Get this gap. We pull back to the 40. Get the gap. Pull back. Of course, this was the coronavirus, and we were way extended. Anyway, I was telling my subscribers that back in here, even before things started to happen with the coronavirus, that we should expect a pullback, and sure enough, that's what happened. But it also coincided with what was happening with the coronavirus and the shutting down of the economy. So that's why we got this steep sell-off and, of course, a very quick rebound. But once again, we find ourselves very extended above the 40-week moving average on the S&P 500, which, of course, is a great indicator for the entire U.S. stock market, and that's why I do most of my analysis here on the S&P 500. But trading this far above the 40, guys, it's not a matter of if, it's just a matter of when we are going to pull back. We don't always pull back exactly to the 40-week moving average, of course, the equivalent of the 200. But when we are this far extended above the 40-week moving average, and we're in the worst 3 months of the year, August, September, October, and we're facing a contentious presidential election here in a couple of months, guys, we should expect this market to pull back here at some point in the not too distant future. I believe that is probably what's going to happen. I don't know exactly when, but it would not surprise me over the next couple of weeks or so to see the market to start to roll over and at least head down towards, if not to, the 40-week moving average, if not slightly below, down to maybe the 3,000 level, which is where the major area of support is at this time. Some support at 3,200, but the major area of support right now is at the 3,000 level. But of course, we could stop right there at the 40, as we oftentimes do. The next chart that we're going to look at here is a 5-day, 5-minute chart of the S&P 500. So that's just this week, and each candlestick represents 5 minutes of trading. And we can see that on Tuesday, the 18th, we made a new closing high on the S&P 500, where we closed right here at 33.8978. And we advanced further on Wednesday, got up to around 33.99 for several minutes throughout the day, but just couldn't hold that. And of course, we sold off into the close, gap down on Thursday at the open, and then have rallied from there. And that allowed us on Friday, the 21st here, to close at a new all-time closing high, both on the weekly basis as well as the daily basis. So right now, the new closing high for the S&P 500, 33.9720. And again, that is true for the day and for the week. So 33.9720, a new record for the S&P 500. Now let's take a look at a few of the underlying sectors within the S&P 500 to see what really worked this past week. Of course, we know that the S&P 500 itself was up 0.73% for the week. But when we look at the sectors that actually drove the market to a new all-time high It was predominantly led by the tech sector, which was up 3.56% for just this week. So the tech sector has been extremely strong for quite a while, guys, and we really want to keep our eye on the tech sector, because if the tech sector rolls over, and it's really extended above its 40-week moving average, but if the tech sector rolls over, it will more than likely take the rest of the market down with it. Behind the tech sector for the week in performance was the consumer discretionary sector, up 1.83%, and then behind that was communication services, up 1.54%. Now, the sectors that didn't work this week: energy down 567, the financial services sector down 344, and utilities down 162. The next chart that we're going to look at is for the NASDAQ 100. Of course, the Triple Q is the ETF that tracks the NASDAQ 100, and this is a 3-year weekly candlestick chart. The blue line, once again, represents the 40-week moving average, which, of course, is equivalent to the 200-day moving average. And what we can see here on the Triple Qs, we were up 3.57% for the week, so a great week for the NASDAQ 100, which, of course, is a very tech-heavy index. But we can also see that we're trading at 25% above the 40-week moving average. Guys, that is a long way above that 40 on this index. So just like with the S&P 500, when you get extended above the 40-week moving average on the Triple Qs, you generally pull back to or even below the 40-week moving average. So the way I'm looking at this, it's not a matter of if, it's just a matter of when we're going to pull back and possibly pull back all the way to that 40-week moving average, which if we're trading at 25% above it, guess what? That's going to be a 25% pullback if we pull back to the 40-week moving average anytime soon. So just be aware that this market is really, really extended. And remember, we are in the worst 3 months of the year. It's not always a bad 3 months, but oftentimes August through October can be pretty rough. And it only takes one of those months, right? It could be September, it could be October, but it's not uncommon to get some type of a pretty sharp pullback in at least one of those months most years. Now let's take a look at the Russell 2000, the IWM, which is the ETF that tracks the Russell 2000. Again, we're looking at a 3-year weekly candlestick chart, and again, the blue line is the 40-week moving average. And in the small caps, guys, remember that it's really hard to have a really strong stock market without small cap participation. And what we can see here in this 3-year chart is that where we're at right now, number one, the small caps were down 1.59% this week, okay? And we just saw that the S&P 500 was up. The Triple Qs were up over 3.5%. And here we're down over 1.5%, 1.59% to be exact, for the week on the Russell 2000 small caps. So we're seeing small caps going in the wrong direction. We've got this divergence, right? About a 5% or so divergence between what happened in the small caps and what happened in the Triple Qs. And we know that the Russell 2000 small cap index peaked back in August of 2018, 2 full years ago. So we're actually in a downtrend over the last couple of years, right? From this point to this point, that is a downtrend. We've been in a downtrend in the small caps for several years, and where we're trading at right now is about where we were in January of 2018. So we have literally made no progress in the Russell 2000 small cap index in over 2.5 years, okay? That is not a really strong stock market, guys. So we need to pull back and need to take a look at the bigger picture. And I hope you're seeing that here, that, yeah, it's been awesome, right? What's happened since March 23rd, but the bigger picture is there's still a lot of challenges out there, and we cannot afford to ignore the risks and get too complacent here. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 3386.15. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate the signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are 3 powerful indicators. There's the Simple Market Signals proprietary risk level signal, There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.